Welcome back. Let's get into the year-end rally. That's what we're looking at here, right? Is a Santa Claus rally. Happy Sunday. This is a weekend review. So let's take a dive into why this could be the case. Keep in mind, look, October was the worst seasonal month of the year in general, right? Or September was, or is, and we're gonna look at this in two different ways. So obviously September, historically, how many times we've got to say it? Seasonality, worst month of the year. Well, guess what? It is October 4th. October 4th. It's October 1st. So it's over, right? The pain is gone. I don't know. But when we look at the chart, okay, when we look at the chart, Santa Claus rally, the last, so like, what is this? Five out of the last six Octobers resulted in the market rally. Go back to 2017 market rally, 2018 we had some, I think that was the tariffs, right? That was the Chinese tariffs. We had a lot of issues there. 2019, big market rally, fourth quarter of the year, right? Going into the fourth quarter after starting October, 2020 market rally, October, 2021 market rally before we sold off into the bear market that we have left. And last year, 2022, big rally. So what do you think? Where does the correlations stand? Where do they stand? Probably with the market rally, right? If you go with seasonality, this should be a market rally going forward. And when we look at the technicals internally, we are oversold. We're looking for that bounce. I think we did get the bounce. Oversold. We have support on the trend for S&P, and we're above the 200 daily moving average. So we're looking pretty fresh here. And maybe we bounce and consolidate still. Like this is a nice falling falling flag pattern. Oh, I don't believe in patterns. Well, it gives you a little bit of variables to understand what we might do. I think we go to the top of the range, maybe chill out a bit. We are heading into earnings season, so keep that in mind. We do have some risk to go over, but keep in mind we are looking at earnings season mid-October. I think we get BlackRock, we get the banks like early October, like not next week, but the next week after that. I think we start with the banks, and that's what we should be bracing for. Okay. Now the uncertainties. Before we go over the uncertainties, these are it. Let's make sure you check in with you guys. How you guys doing today? What up, Glenn Stevenson? What up, Yassine? What up, Cole? What stocks would you recommend to long for the next 6 months? Well, we'll get to that, Cole. What I want you to do is keep asking your question. I'm going over the weekend report that is basically a review of last week, what we saw last week, and looking forward, what we can expect looking forward, right? Over the next 6 months. Really, this is over the next 3 months. I think we get a Santa Claus rally. We're going to see Santa Claus come to town. And I think we get a stock market rally. So those stocks that you want to choose, I can't tell you what to choose, but I'll tell you what I think is basically the best. Go to the YouTube, ask your question, Cole, link in the description. You'll be able to see the YouTube, ask your question on there. So let's go over the uncertainties that we're seeing. First, government shutdown. Well, I think that just got addressed this weekend. They at least push it for what, 6 months? I think I was looking up. They pushed it forward like 6 months or 6 weeks. I'm sorry. So that got passed. There goes that risk. Remember, we talked about government being shut down. It's all political posturing. It's going to go through. That is no longer the case. UAW strikes. That is still a risk to the supply chains, possibly to unemployment. I really doubt it. I think wages go up a little bit, and that's not great. You don't want to see wage inflation, but that gives consumers more buying power at the same time. So yeah, UAW strikes still pose a risk. Appreciate the love, Taylor. Appreciate it, man. Ask your questions. The price of oil, right? Oil prices rising is a risk, right? But I think it more so, and we're going to get to it, slows the economy. If we get a spike, we'll see what happens. But oil prices going higher. Mortgage rates, wait, like, bro, what, 8%? Mortgage rates are too high. This is a problem. Rising auto delinquencies, rising commercial, industrial, real estate delinquencies, right? They're not even rising at this point. The autos are rising, but commercial real estate, they're actually like, I think they've already blown up from what we've seen on the charts. But we're not going to go over that chart. Tightening macro forces immediately. If you're trading, whatever you're doing, these are the things I'm mostly worried about. How long do these, stay in place? Tightening macro forces, dollar, yields, oil, right? That's a big problem for risk assets. And the recession, right? Just plain and simple recession. Are we heading into a fourth quarter recession? You hear it everywhere. The economy is slowing down. We're going to collapse, blah, blah, blah. I don't think that's the case. There's some slowing going on, but let's check it out. Let's dive into the economy first, right? We start with economic activity first because that leads GDP. And what we're seeing in the manufacturing sector, it is recovering. Okay, manufacturing is recovering. Oh, let me show you the charts. Manufacturing is in black, and I'm sorry, red, and services are in black. Okay, 50, you want to look at the 50 mark. The 50 mark is expanding if you're above it, contracting if you're below it. So far, it looks like we are rebounding from cycle lows, right? You're starting to rebound here. And what I want you to keep in mind is this is coming from government spend, public and private sector investment into multifamily homes, apartments, and infrastructure. So the Biden administration, Inflation Reduction Act, CHIPS Act, I've said it 1,000 times, the infrastructure spend is pouring into, is pouring into manufacturing, right? Even though there is some manufacturing weakness, it is starting to bottom out. You see, it's not shooting straight up, it is bottoming. So we're getting a recovery in the manufacturing sector. Services, I think, continue. Why? Because we're heading into what? October, Halloween, November, what is November? Thanksgiving, right? So people are going to be traveling, they're going to be spending, they're already going to be spending on probably Amazon or, wherever the deals are at for Christmas season. So it's seasonal spending, the Santa Claus rally, right? That's why we're calling it the Santa Claus rally. And so I think services are going to be strong. I think we continue to expand. Maybe January is where we see some weakness. What I want you guys to watch out for coming up this week, it's always the first week of the month, October, you get the PMI, you get the ISM, the red, the red indicator, the ISM manufacturing index. You're going to get that I think it's Monday or Tuesday. We'll double check that. And you want to be keeping your eye on new orders. Do new orders continue to rise? New orders are going to reflect, new orders reflect the business cycle. They reflect the recovery. They reflect the forward-looking growth. If you're getting new orders continue to pick up, throw the recession out of the bag for now, right? At least for the third quarter, at least for the fourth quarter, throw it out. It's not coming. Maybe in Q1 of 2024. But if those new orders keep going up, manufacturing is recovering. Okay. And then next it's services, right? But people are going to spend. That's my bet. All right, jobs. How are jobs doing? We're going to get that at the end of the week. Payrolls. We want to see payrolls. Are they still falling off? Well, they're not falling off a cliff. They're decelerating, but they're not, they're not negative yet. So payrolls are still positive, even though they've got revised down. We know they're weaker than expected, but we got fiscal stimulus coming in fourth quarter. So more jobs in certain areas and weakness in others. Unemployment. Is it sneaking higher? Right? Where's unemployment? Is it spiking? Is it sneaking up? Is it terrible? Is the market going to freak out? Keep your eye on that. Wage growth. Is wage growth going to be sticky? Is it going up? Is it going down? Is it sideways? Employment overall is probably the best indicator for the coming recession, if there is one, right? So we should be at, typically when employment is this tight, when the unemployment rate is at the lows, typically that is called early cycle recession or late cycle economy, where unemployment rate should be spiking up. But I'd argue that fiscal stimulus coming in and the pandemic stimulus that is still in, and savings, and the data is much different than it was in the past. So it's a really weird, macro backdrop. But keep your eye on employment. So unemployment rate is going to be big. Plus, it's a backwards looking indicator also. That's why I like to look at new orders. All right. Economic growth. We're at 2.1%. Okay. That is the expectation to finish the quarter off 2.1% for third quarter GDP. It is decelerating, but at a very slow pace. We're not falling off a cliff. We're not going negative. We'll see that if it does come into the data, but so far it's not falling off a cliff. We're looking pretty solid for GDP. The growth rate is not negative. We're not headed for recession, but we are slowing. Okay. Consumers. We just got this consumer report. Consumer report, right? And you can see here, spending is down. So spending down month over month. These are month over month numbers. So they give you immediate data. Spending is down. Savings rate down, right? It's not collapsing, but it is down. Incomes are up. I thought that was kind of positive here. What you're seeing is spending is down. Okay, we expect that. No surprise there, right? People have been spending less, but that's good for inflation. That's going to be good for the Fed and the market looking at expectations. Savings rate down. Well, what are they doing? Are they moving that money into money market funds, or have they just been using their savings to pay off their debts? Possibly, right? So savings are coming down, but the savings coming down also tell you they are still spending, right? Nothing is really, you're not seeing a big, huge divergence, but incomes are up. I think that's really the divergence here, is if incomes are up, and spending is down. Well, that's positive, right? Because you have more income. Maybe they're saving for recession. Maybe people keep hearing it. Maybe they're saving for maybe they're spending or saving for the seasonal seasonality. Thanksgiving, got to buy that turkey, presents for the cousins, for the kids, for the mothers, for the fathers, for the grandparents. So I think we still get more spending into the fourth quarter. The consumer report doesn't show any deep weakness, no big concerns, right? Not yet. Consumers are in good shape for seasonal spending. When we look at the household financial debt to disposable income, they still have disposable income, right? This is the ratio between debt and disposable income. It's very low, which means they have a lot of disposable income versus historically disposable. The debt, well, this is basically your debt against disposable income. Historically, the debt was climbing, right? What is this, like from 10 to 12% to 15% versus disposable income? Now we're below 10%. So what does that mean? That there's not a whole lot of the people can spend. They can keep spending into the fourth quarter. That is my guess. Macro forces, right? We'll get through the report, then we'll get to the questions. We will get to your questions, Yassine. Also, spy questions. Yeah, all those questions. Throw them on YouTube so they don't get lost, or just keep asking them. I'm almost done. We're halfway through. Macro forces, the dollar. And what are we talking about here? First of all, if you just showed up, we're talking about a fourth quarter rally, a Santa-Claus fourth quarter rally. Are we going to get it? Is that in place, right? Are we seeing that develop here? And so far, the economic activity is recovering in the manufacturing sector. Okay, seasonality, we know the S&P always recovers in the fourth quarter. 5 out of the last 6 years. Yeah, I got that right. Look at October. Go look at October to December, right? Recovers most of the time. That's like 90 or 80% of the time. So I think we get that because people are going to spend into the fourth quarter. We get an earnings season. We're going to find out who's weak, right? Who's struggling. Anyways, macro forces, the dollar, oil, and long rates are tightening. So this is, oil moving up, right? That's tightening conditions. That is not great for the economy, but it is good for earnings in the energy sector. It's also going to slow inflation because people will spend less. And that's probably going to hit them in the fourth quarter, at the end of the fourth quarter, going into January, right? US 10-year yields, this is the big rate risk we're talking about. This is actually the bigger risk, I think, because it has to do with debt. This is government debt being sold off. Okay, you need to be able to fund your debts. And what they're doing is they're increasing the supply. So I'm not that concerned about it because it's not like people are dumping US debt. It's more so that US is creating more debt. So it makes rates go higher. Okay. US dollar is breaking out. Hopefully it reverses, but we'll see. We're right there. Now for the offsetting, right? If you look at all these macro forces, I think they're still being offset. How? Well, yes, oil is up. That is a huge commodity, right? Oil is a huge commodity, but natural gas is still at the lows. It's still down 70%. It is not spiking. Okay. And going into the, what is it? The cold season where people get colds, they got to heat up their houses. Natural gas is still low. So we're not really seeing energy, electricity, prices spike right now. Commodities are not telling this. I think this offsets the negative macro forces or the tightening of conditions. Here's an easing of conditions. Nat gas is low. Copper still low, still trending low, right? Kind of balances things out. Wheat futures, right? So you like those carbohydrates, whatever it is. Wheat futures are down. They're actually collapsing even further. So wheat futures are down. There is no, food inflation is falling. Yes, prices are high. I get it, guys, but we're not talking about what is now. Inflation is about what is to come into the future, and the rate of change of inflation for food is down. Prices are not going up as fast as they were, but they're still elevated. It still hurts your pockets. I get it. But there's not the risk that it goes up. Okay. So basically macro forces are tightening conditions. The biggest forces, oil, the dollar, right? US oil, not US oil, but oil in general, the dollar and rates, long rates. But we do see that wheat, commodities, and nat gas are actually helping to ease those macro forces, right? They're easing here. And the bigger deal is shadow QE. Okay, we're talking about long rates going higher. What about short rates? Okay, short rates, the 2-year rates, those aren't going anywhere. Look at, they're moving sideways. So hey, yeah, long rates are up, but short rates are down. Why? Because QE, because of shadow QE. Here's the reverse repo facility. I say it all the time, shadow QE coming into the market. And they're basically buying up US debt. So all the money that was at the Fed, right, in the reverse repo facility collecting interest is now coming out of the Fed and going to buy the US treasuries that are being dumped on the market. But they're not buying 10 years, which is why the 10-year, right, the 10-year is spiking. So looking at the 10-year, it's spiking. They're not buying 10 years. It doesn't give them it doesn't benefit them. It benefits them better because they get more yield on the 2 year. So hey, short rates are down and long rates are up. That's I think that kind of dampens things down and it's not too bad, right? Okay, rate risk. What is the real interest rate risk of the 10-year, the 30-year keep climbing? This is a big problem. This is going to be scary, right? Most companies, though, keep this in mind. Most companies, right? Most companies and most mortgages are already locked in. Okay, they're already locked in to short rates, right? They're already locked in lower rates earlier in the cycle during COVID, so they're not really at risk of the Fed rate hikes at the moment. Yes, it will come into play, not till next year. It's getting pushed out further. I think they say it takes like 24 months. But right now, companies, we're talking about a Santa Claus rally here. We're talking about the Santa Claus rally right now. Those rates are not affecting companies that have already locked in rates, and most of them already have. Most mortgages are already locked in. They're not, they're not variable rates. That's in the UK. That's not here. Okay. So regional banks, commercial real estate, and floating rate borrowers, they're the ones who are in trouble, right? If you have floating rates for credit cards, for your house, for your business, if you do have a floating rate, you're in trouble because when the Fed hikes and bond yields go higher, I mean, shoot, your payments just went higher, your interest rate payments went higher, and your revenue's probably down because we are kind of slowing, and you might be in trouble. So we'll see that come out in earnings, right? The answer to higher oil prices is actually higher oil prices. And what that means is, yes, oil's up, but the Fed can't do anything about that. All they can do is allow it to work its way through. It's going to slow down spending. People are like, oh my God, my bill was 50 to fill up. Now it's 70. It's up 20%, 30%, 40%. Well, shoot, I better pull back on buying these chickens, these extra chickens over. No, I'm just kidding. I bet they're probably going to buy food. I better pull back on buying extra clothes. I better pull back on going onto this Taylor Swift concert. Hopefully they'll probably keep spending. I need to pull back on my spending, and that's probably what's going to happen. And CPI comes lower, and we have a lot of upside for CPI that we just got this weekend. I don't know, and nobody's talking about it. We're going to get to that. PCE, the Fed's preferred inflation gauge, came in very solid. Okay, the answer to high. So if something does break, though, right? We're talking about rates on the long ends climbing. If something does break, what is the issue? Well, the issue is not really that big of an issue because the Fed steps in. That's what we saw last time, right? The Federal Reserve's balance sheet picked up. Okay, I really doubt they don't step in again. They stepped into SVB when all the banking crisis happened in March, and the rate risk went away. Those bond vigilantes covered their short positions. Okay, and the Fed actually bought treasuries on the long end to cover the weakness in the banking sector, and the market bounced. So if something does break, I'm actually optimistic. We might get some, if something breaks and it drags on, the market's going to freak out. But all we got to do is look at the Fed's balance sheet. If it steps up, we're good, right? And that brings us to the Fed balance sheet. If it does go higher, they're basically QE really quick. They'll probably shave it off again, and the dollar goes lower. Therefore, the rally is fueled. The fourth quarter rally goes higher. We're gonna get that fourth quarter Santa Claus rally if something does break, as long as it's not too systemic, right? It wasn't the big banks that failed; it was the regional banks, right? So, will the Fed hike? This is the next part. Will the Fed hike this whole month? They don't have a meeting. They don't decide this meeting. So, we're going to be looking into PCE data, right? My bet is that they actually pause this next meeting. I could be wrong, but if we're looking at the labor market coming up, everything points to the labor market weakening. And so, my bet is that they do pause. Also, look at PCE data year over year. It is coming down. This is the lowest level we've seen in PCE at 3.88% core. PCE, they're looking past oil prices, they're looking past headline, right? 3.88%, lowest level since May of 2021. That's about 26 months we haven't been at these levels for 26 months. That's a long time, 2 years, right? A little over 2 years. Lowest levels on month over month, which is even more positive on the month over month data. You're at 1%, 0.14%, right? This was the lowest since November of 2020. That is 33 months of data. Or I mean, so 33 months until from last time we had this got to these levels. So inflation is coming down. Core is coming down. I think the real risk is going to be forget the oil price. That's going to slow consumers. It might be, in the headline for a little bit, but core is coming down. People are slowing in their spending, but it probably doesn't slow completely because we're in seasonality, because we're headed into Santa Claus rally, right? We're headed into Santa Claus season where people want to buy what they don't need and give and show what they don't have for people that don't care. So they're going to keep spending. And I think core PCE doesn't spike because they're not spending as much, but it doesn't collapse. They do keep spending, right? The word on the street. Here's the bullish side. Also, remember, we're still remember 5 out of the last 6 years in October through December, the market went higher. We just saw the seasonality on that, right? And now we're getting people are getting fearful again. So what am I pointing out here? Buy side fund managers are overweight energy and industrials. Those are the two sectors in the S&P that they are overweight. Energy, obviously, oil's going higher. Industrials, why? Fiscal policy, right? Industrials are basically, well, if we're going to send money to Ukraine, we got to build weapons, and that's industrial production. That's industrial stuff. Also, if you're building infrastructure, CHIPS Act, all these different manufacturing facilities, you need industrial investment. So they're overweight that, and I think it does do well going into the fourth quarter. But they're underweight rate sensitive vehicles, right? Rate sensitive. Who's rate sensitive? Companies who have not earned, who are not positive on their earnings. Companies who have not turned a profit yet, right? Who need low rates to survive, or who has to refi the rates, they're in trouble. So there's going to be a real dislocation here. What I think we see is you see the weakness really leave the market in this next earnings season. If you're weak, you're done. You might not come back. You might not bounce back. There's no free money. There's no low rates. But also, you're going to see money go into companies who benefit from fiscal policy and benefit from the economy and benefit from the secular trends that we're about to see. Why? So when everybody turns bearish, that's when you get bullish. Now everybody's starting to turn bearish, right? They're not extremely bearish yet, but they've been pretty bearish. I think the shorts are covering. This is the bull bear spread. Okay. And we're in negative territory again. Okay. Last time we were here was before the big rally in June. So we'll see this whole month. I think you're going to see buying take place this whole month and be, supported. We'll see when earnings come out also. The second week of October is going to be huge, right? Leveraged. Oh, this is okay. My bad. This is margin debt as a percentage of S&P market cap, right? Margin debt is very low. What does that mean? That traders, investors, fund manager, whoever it is that borrows and leverages up, they're not leveraged anymore. They actually de-levered for the past 6 months, 8 months, they de-levered. So there's a lot of fuel, there's a lot of cash, forget your cash. Maybe you don't have cash, but you can borrow. That's what margin debt is. And when debt levels are this low, you can only go up from here, because any bit of positive news, earnings are better than expected, Nvidia below our earnings, oh my God, full self-driving, oh my God, Bitcoin ETF, any kind of catalyst, right? Apple comes out with a new product, Meta, whatever it is, this debt starts to come back into the market. Margin debt is a reflection of where people are positioned. And right now they're positioned offsides. Okay, we haven't been this low since 2003. We haven't been this low since 2003. So, hey, we're in we're setting up here. Also, people are overweight bonds, even though the bond market is selling off. So I think there's going to be a bottom in the bond market on the long end at some point. The short end already bottomed. Okay. But the real thing here is that equities are still underweight, right? More than REITs, right? REITs are underweight and equities are underweight. Technology is still underweight. So people are, fund managers are still underweight equities, especially for tech. Okay. They're probably overweight in industrials and energy, but underweight tech, right? So my expectation before we hit the comments, the questions, blue chips, check this out. Blue chip companies, Apple, Amazon, Google, Facebook, they have enough cash, and there's more, there's more blue chips than just them. They have enough cash to fund their own debt, to fund their own borrow. Oh, don't forget, upgrade to the subscription if you just want to support the grind. I would appreciate it 100%. I'll shout you out on the video. This is the macro report. We skipped last week. We had it this week, right? Anyways, back to the story. Blue chips, okay? Big stocks that have a lot of cash. What are they doing? What can they do here to survive? What they're doing is they say, oh, you're going to give me 5%. Let's say the Fed is higher for longer. Okay. 5, it might not even matter. Honestly, you're at 5%, 5.5% Fed funds rate. Well, you're basically collecting 5% at the money market funds if you park your cash there. So big companies can park their billions of dollars of cash in the money market fund, collect 5% interest, and pay off their 2.5% debt servicing costs for the debt they've already borrowed. Therefore, their debt is obsolete, and they have extra cash flow from the money market funds. So it's crazy. It is kind of crazy because, short-term treasuries are back. They're going to yield you a lot of interest higher than your debts. So the companies who did well are going to do better. That's basically what we're seeing here, right? Earnings are going to spark this year and rally, in my opinion. And I don't think consumers barf until 2024, maybe Q1 or Q2. I don't think they barf till later. So that's my expectation is we have, this is it. This is what we're looking at. And I think the main event here to look at overall is, hey, this is S&P 500 Santa Claus rally setup, also NASDAQ, whoever it is. The best companies will survive, the strongest will survive here. And most of the time in October to December, you get a market rally. Okay, this is happening most of the time, and we just had the seasonality. We had the worst. September is always the worst month, and that played out exactly to the T. So don't go until Monday, tomorrow, October 2nd, and say, "Oh yeah, the market should go back to all-time highs." No, just keep your eye out for the buying pressure over the next couple weeks, and you have earnings. And hey, this is a good setup when you're negative into earnings. That's a good setup for underweight positioning, and then if it's better than expected, overweight on certain stocks, right? Okay, we'll get to the questions now. Let's get to the Q&A. Let's get to the Q&A here, and then we'll look at the charts if we need to. We have Yas. Let me see. How would that affect the dollar seasonal spending? Well, right now, seasonal spending isn't necessarily going to move the dollar. It should make it stronger, but not really. I think what mostly is going to happen is if rates keep increasing, then the dollar is going to strengthen because right now the US is probably the best economy, given looking at the other economies. So that doesn't move the dollar. And I know you're a Forex trader. So more so look at China. They're still stimulating. China is increasing liquidity. That's going to move the dollar higher. I don't want to see the dollar go up, but the dollar won't drop until maybe it drops when the Fed announces the pause for forever, which I don't know if they're going to do that. I think they're going to try to keep expectations that we're not going to pause, or we could always hike again 25 basis points if we need to. And I think that might be true. So I don't think that gives you any insight on the dollar movement for spending, though. I feel like there are a lot of positive news for the dollar, but I don't understand how dollar could go down now. The only way the dollar goes down is if the Fed cuts rates. Here's how the dollar goes down. We do get a banking crisis. Okay, something does break in commercial real estate, something breaks in the mortgage market, something breaks in the banking sector, and the Fed has to turn on the balance sheet again, turn on the money printer, and you debase the currency, and that's how you get the dollar move lower. That's about it. Margin debt, could you find that on TradingView? I don't know. That's a good question. I've never looked at it on trade. I've never tried to find it on TradingView here. We'll see if we can find it. I doubt it. Move this over here. I really doubt it's on TradingView. Let's see. Could be. There's a lot of stuff on TradingView I haven't looked at. All right. So what I'll do usually is go to indicator, see margin debt. No. I don't think so. I think I don't know where to find margin debt. If I see somebody post it, then I'm gonna spin a story off of it, right? Margin debt, for the most part, though, it has been falling. We talked about it like 3 or 4 months ago. Margin debt declined insanely. What it basically means, because it's a secular thing, right? Margin debt day to day is not going to tell you much. But margin debt at these low levels tells you from a macro perspective that we're close. It just takes one positive catalyst, earning season, okay? Inflation coming in better than expected, as we just saw. It just takes one catalyst to get that margin to start. People love leverage. They're going to start pumping in again. Okay, let's leverage up, leverage, leverage, leverage. I think you need rates to really ease off, though, the long rates to ease off. So that's what I'm guessing. But look at this beautiful trend, right? We're oversold. We're going to bounce. We bounce every single time. We're above the 200 daily moving average. We're in this falling pattern, and maybe we come back up and then to retest the trend, and then we sell off right back and make a higher low. Though I'm looking for the higher low. I'm looking for a big move up, okay, and a higher low. That's when I stay bullish. I'm like, okay, we're gonna remain bullish here. If we come up and then make a new low, I'm gonna say, wow, okay, that's not good. But we're oversold. So the more bearish scenarios, we go all the way back up and then we make a new low. That's when I'll say, okay, that's not good. We need to go up, test the trend, and then make a higher low. That's kind of what we need to see here. Also, the move index did finally peak out. right? It did finally peak out. And could be because we just saw bond, not bond volatility, but we just saw the government shutdown was resolved. It's going to get resolved. Okay, that was one of the issues here. Government shutdown, resolution, AUW, all the bears, right? All the bears that are betting on the market crash, those narratives are going to be unraveled as the risks start to disappear. They're going to get unraveled here. Long rates to ease, of what do you mean by that? Okay, here's what I mean by that, right? Short rates are 3 month to 2 years. I mean, there's always an argument. Those rates are not moving higher, right? That's because, actually, this is going to look better here because no, it's going to look better here. Here we go. I mean, I put this in the actual macro report, but just to get some more literacy here, because sometimes like, what are you talking about, man? This is global liquidity at the bottom, but I'm going to turn on the reverse repo facility. Okay. So this is what I mean. The 2-year yields, 2-year bond yields for the US, 2-year treasury yields, they're not moving up. They're stuck at this point. This is like 5%, a little above 5%. They're stuck here. They're not moving up. If you go to the 10-year, the 10-year it's breaking out. 30-year breaking out. Long rates are breaking out. The reason for this divergence, the reason why rates are not moving together is because, for one, the US is dumping debt, right? The US Treasury is literally creating more debt, but they're creating more debt on the short side. So you would think this goes higher, but that's not the case. Why? Well, actually, let's get to why it's going higher. China dumping US debt. That makes rates go higher. Okay. US Treasury dumping treasuries debt, US debt, that goes higher. The US Treasury themselves, I'm sorry, the Fed is dumping debt. The Fed is dumping debt. Okay, so yields go higher. Now you want to know what debt what debt is actually moving here. Well, the reverse repo facility, this right here in the blue, this is money that's parked at the Fed. It's called shadow QE. That's what I call it. If you invert it, I always like to invert it because it's hard and confusing to explain otherwise, right? Oh no, not this, bro. Come on now. Let's invert this one. Okay, keep your eye on it. I want you to keep your eye here. The heck? Why isn't it giving me the ability to invert the scale? Come on. Just when I need it most. Doesn't even work. That's weird. Oh well, we'll just look at it like this then. Okay, so this is reverse repo facility cash parked at the Fed. So let's think of it this way then. This cash is leaving the Fed, okay? And where's it going? It's buying these bonds. That's why it's not moving up. So they're capping rates here. The liquidity that's parked at the reverse repo facility, right? I call it shadow QE. It's been leaving the Fed for a while now, since January, got up to $2.5 trillion of liquidity. Now that liquidity is coming back into the market. Where is it going into the market? Is it nibbling on stocks? Maybe, but it's definitely nibbling on US treasuries at the short end. Okay, so they're not going higher. But what it's not doing, and here's the reason why: they're collecting 5% interest. If they buy these, they're getting 5% interest every 2 years. Okay, that's really short. But look at how great this deal is. You're getting let's just call it 5.5% interest every 3 months on your money. So every 3 months, you're going to collect 5.5%. That's great. That's better than any other rate you're going to get, right? So that's why short rates aren't moving up, because this liquidity is buying those short rates. But long rates are not yielding the same, right? And this is why they say rates are going to keep going on the high end. They're going to keep moving up until that reverse repo facility is incentivized to go after this. Why is it not incentivized? Because this is only yielding you 4.5% in 10 years. Bro, who wants to wait 10 years for 4.5%? Nobody. They want 5% in 3 months. So that liquidity is not interested in this. That's why it's moving higher. Plus, you got bond vigilantes. You got Bill Ackman. You have a bunch of, Wall Street guys that are shorting the U.S. Treasury at the same time because they know that rates are going to move higher. They already broke out, and they know they're going to move higher because this reverse repo liquidity is not buying them. Okay. But it will start buying it if it gets closer to 5%. That's when it'll start buying. Okay. So this isn't being driven by inflation. Typically, bonds sell off, rates go higher if inflation's going up. That's not the case today. We just saw the CPI, right? The Fed's preferred inflation gauge, PCE. We saw that come in really good. So these should be lower, but it's just not happening. Why? because growth expectations are also higher, which is why I say if even if the economy does start to slow, well, rates are going to ease, right? So it's like, is good news bad news still? I don't know. It's crazy. But either way, I think consumers keep spending. Maybe this rate does go higher. We'll find out. But if something breaks, it goes lower. Okay, if something breaks, it does go lower. I don't know if that answers your question, Yasin. 10-year yields, long rates, and 2-year low rates. Yeah, I mean, to put it in context, bonds are actually anything above 10 to 30 years. Those are bonds. And then bills are, well, you got bonds, you got bills, and you got notes. No, I'm sorry. Yeah, bond, bills, and notes. So the 10-year is technically the 10-year yield or the 10-year bond, right? This is the yield. They move opposite. Technically, it's a 10-year note. Stupid. It's just language. It really doesn't mean too much. It's just whatever. This is a 10-year note, right? So some people say from 5 to 10 years, right? These are the two. From 5 to 10 years, those are notes. Those are midterm. Those are middle. And then it just depends how you measure the scale. And then from 1 month, I don't even have the 1 month up here. I'm not going to put 1 month all the way to 30 years. That's too many. That's too many indicators. I just want to see short rates. My short rate measurement is 3 month to 2 year. Those are short rates. Okay. And then from 5 to 10, those are mid rates, but I don't really look at the 5 year. I just have it up there just to see if anything's changing versus everything else. So far, it looks the same. It's pretty much moving with the 2 year. Okay. If I look at the 10-year, the 10-year, this is the note, this is the benchmark rate. So if you ever hear about rates or bond yields, the benchmark rate is the 10-year. That's the benchmark. It's in the middle, right? It's in the middle between 30-year and short rates, 2 years, whatever. So it moves. It's very confusing, bro. It is. So all you got to know is this: from 10 to 30-year, those rates are breaking out. Look at the last high. Those rates are moving higher because this liquidity is not eating these rates because the yield is not good enough. They're not collecting enough interest here to want to get there, right? But if you go to the short end, 2 years, well, you're going to get over the next 2 years, 5% interest. Obviously, they like it. They're eating it up. That's what the U.S. Treasury is offering or supplying. And then if you go to 3 months, I mean, the deal's even better. You're getting 5.4%. How many S&P companies are probably doing this? Imagine Apple parks $10 billion of cash for 3 months. What are they going to get? 5% would do the math there. What are you getting on 5% of 10 billion? You're getting, let's see, 10 billion, 100 million. You're getting like $500 million of cash flow every 3 months, right? I mean, not, it's probably a little more complicated, but that's a lot of money every 3 months. So that's why I'm saying these big tech companies they're going to get bid up. They're going to get bid up going forward. They're not going to be the only ones, but they can sustain their own growth because of this bond market backdrop, this environment right now. You try to invert the chart on TradingView. It worked once, but I forgot how to do it again. Do you know how? Yeah. Usually to invert you just go to the letter here. I don't know why this isn't letting me Z. That's stupid, dude. That never happens to me. Yeah, that's weird. That's annoying. Here we go. I had to right click it. Maybe you have to right click it. Invert scale. There you go. Let's keep it inverted there. Got to keep that inverted. I don't want this inverted though. That liquidity is going lower. Fed net liquidity is falling. Uh-oh. Sell off alert. We'll see if it goes up. It's going back to the low. So this is Fed net liquidity. This is also the Fed. This is what I watch to understand, hey, where's liquidity heading? I want to see reverse repo liquidity. I want to see global liquidity. And I want to see the liquidity doesn't look good. You know why it's selling off though? Because the 10-year yields are going higher. And that is collateral. I say this every single time. When collateral falls, then you can't lend as much because you don't have enough collateral. It's just like if you're borrowing on Robinhood or margin. If your cash position is lower, you can't get as much margin. The more cash you have or the more stock you own, the more you can borrow off of margin. So the more cash you have, the more liquidity that comes out of nowhere, right? But right now, as these 30-year yields climb, it's literally bonds selling off, or you go to TLT, it's literally TLT going lower. So this is the collateral falling. As the collateral falls, you can lend less, therefore liquidity falls, right? That's keeping liquidity down. That's how you use that chart there. Yeah, I guess if you got to right click it if it doesn't work. See, now it's not working. It's weird. That's weird. Oh well. What else we got here? Santa Claus rally. Tell me why we don't get a Santa Claus rally. What's in the way of the Santa Claus rally? I don't see no comments. I guess it's gonna happen. No, I'm just kidding. Let's see. Oh, tomorrow we'll get the ISM numbers also. Let's go back to S&P. Take a look at the VIX here. The VIX is slowing down. Watch the VIX. If it consolidates under 20, if it stays down here, I think that's going to be pretty positive going forward. See what else you have. I want to know, you have so much knowledge. Did you learn this a lot by reading books? Honestly, there's probably books, but I learned this by I watched a lot of podcasts. I don't as much now because I'm creating content, but I watched a lot of podcasts, and every time I hear something I don't understand, I look it up and I do research. I'm probably like a master researcher. No, I'm just kidding. I'm not a master researcher. I just do research. I'll look it up, I'll Google it, I'll dive deeper, I'll read the documentation and try to understand the concept, and I'll YouTube it too. I'll plug it in, say, okay, where can I find this? So I listen to podcasts. I do have books, but not really. Books are slow. Book knowledge is good for base things like fundamentals, but like this kind of stuff, you're not gonna find this in a book. I found this off a video. This guy was talking about the reverse repo facility. I was like, what the hell is that? And then I started looking it up and I was like, what does it do? And I started asking all these questions. And then finally it actually starts to play out. And I'm like, all right, well, here it is. Here comes, I call it the cushion. It's really the reverse repo facility, the RRP. I don't really like it down here, dude. I'm gonna move this. I don't like this. This is annoying me. Let's move this to the panel up there, existing panel above. Yeah. Yeah, I don't like that. And then I'm gonna have to not do a log scale. Let's take the log off. There we go. Yeah, that looks better. That just irked me a little bit. So basically, I was waiting for this liquidity to bottom out and come back up into the market. And what was this? December of 2022? January is when we got that big breakout in the S&P, right? Where is it? S&P breakout. So S&P bottomed here, and funny enough, it bottomed. The S&P bottomed while the reverse repo liquidity bottomed also and started to move up. And then it came down, S&P comes down. I'm like, whoa, these things are very correlated. What's going on here? It could be that they're eating interest rates, right? This liquidity is eating interest rates. I'm sorry, they're eating debt, US debt. They're coming in and buying the US debt, which supports stocks. Because if you eat US debt, rates come lower, right? They're all correlated to some degree. The more this liquidity, or the more buying, the more demand. This is a concept people need to understand going forward because they get tricked by the Fed, right? The more this eats demand for debt, I'm sorry, the more demand for debt, the more that people or investors or market makers buy US debt, the lower the damn rates go. Okay, the lower the rates come, and if the rates go lower, the S&P is like, I love it. Lower rates to fund my growth, to fund debt. Let's go, right? So S&P goes higher. And that's probably what the correlation actually is. Yeah, that's what you see. The banking crisis. I mean, the banking crisis, the Fed printed money. That's a Fed balance sheet. I don't even have this up here anymore because it's just falling apart. It doesn't serve my narrative. No, I'm just kidding. We use the Fed balance sheet whenever we try to show KRE, which is the regional banks. That thing exploded when the regional banks broke. So once we see the breakage, we'll pull that out again. To find that, I think it's wall clave. Indicators, hit indicators, and then put wall. See? No, it's not indicators. My bad. It's not indicators. It is, you want to add a symbol here. My bad. Wall C. Okay. Total assets, balance sheet, total assets of basically the Fed. Okay. Wall, I think of it WALCL. Yeah, that. And this is the Fed's balance sheet. This is the actual Fed's balance sheet. There's all these wonky things, bro. That's why I try to simplify them. See how it exploded higher in March, and the market went higher. So yes, reverse repo facility didn't come in, but the Fed's balance sheet stepped in and ate up the treasuries and ate up the debt. So this balance sheet came in, ate up all the debt, fixed all the deposits, and the S&P bounced, and it never came down from there. Well, now it's coming down, and this balance sheet's going lower. So they plugged the holes. It's like they put the Band-Aid on, and then they kept punching, right? They cut you up. No, I'm just kidding. They didn't cut you up. They stole your money, and then they put a Band-Aid on your cuts, but then they keep stealing your money, right? So that's kind of what happens. So if something breaks again, boom, I think it goes up, and that's going to put more fuel into the fire. Not for every stock though, unfortunately. It's IWM. I know a lot of people trade that. I don't know if IWM is going to survive because it's full of it's full of stocks and companies who just are not profitable yet. So there has to be some real catalysts in there, like, oh, we're going to bet on this next 5 years, promising technology, promising guidance, whatever it is. Other than that, nobody's going to buy it. VIX being like 20, would that be saying S&P would be going lower? Yeah. The VIX and the S&P literally move opposite direction of each other. Okay, watch. This is the VIX. I'm going to overlay the S&P 500 so you can see what I'm talking about. Let's overlay it, right? Now the VIX doesn't trade like a trend because it's not a stock. So when you do this, you don't want to do a log chart for the VIX, but it's pretty clear here. Every time the VIX spikes, let me see, is that clear? How clear is that? Let me make sure it's pretty clear. Let's turn this into a line so you can see it better. All right, there we go. So every time the S&P spikes, I'm going to draw on it. Every time the VIX spikes, we can go back to, let's go back to when the VIX started trending higher. So the VIX is in blue, right? See how the VIX started trending up and the S&P started trending lower? Okay. Well, they move opposite. Why? Because when the VIX goes up, you're buying insurance, or there's a demand for insurance against the S&P 500. You're buying insurance that it collapses. So, market psychology, if they stop buying it, then they're more confident they're buying stock. Okay, when you get these big, now we already bottomed the S&P, so we're back in the bull trend, I say, right? We're kind of breaking the trend, but we're still in the bull market. We'll see this next earnings season, right? Now, when the VIX does spike, look at this big spike. Boom. What does the S&P do? It spikes lower. A little spike in the VIX, spikes lower. Little spike in the VIX, spikes lower. They literally move opposite, right? When the S&P made the big run, the VIX comes down, right? So the thing about the VIX is above 20 is when there's real volatility. Between 20 and 15, it's like mild volatility. Below 15, you're in a bull market. You're in a pretty strong bull market. So I thought we'd stick there, but we didn't. We're not ready yet. We got back to almost 20. I mean, because all the risks are not gone yet. We talked about the risk, not student loan repayment. That's not the big risk. It's the AUW strike. It's supply side inflation coming back. It's China invading yuan. It's oil spiking too fast. It's the dollar breaking out. Like, there's other risks, and it's only a matter of time before they disappear, right? But just keep your eye on the VIX. That's what the VIX does. That's VIX volatility. What else you got here? Can you explain the news on Saturday for China that came in at 52 saying economic is expansion? Oh, is that what I wrote? Yeah. We'll talk about that, because the whole narrative is that China is going to bring down the US, right? There's a negative narrative there, and it could very well. But the Chinese are hoarding oil reserves. Hopefully they're not, waiting for a war here. That's a fun narrative to play with. I don't think it's reality. So basically I posted, you're talking about my Twitter, huh? I think I posted on Twitter. Yeah, here it is. Let me show it. China's going to come out with some more data here too. Basically, the Chinese manufacturing, this is the second largest economy in the world. You got to keep watch on what they're doing, or how their economy is actually going forward, right? So this was Friday. I think I'm answering your question, right? The consensus for the PMI so their manufacturing activity, which leads the economy, your manufacturing activity leads the economy. And when your manufacturing booms, your economy booms, right? It was expected to come in at 50. It came in at 50.2, right? It's not an amazing beat, but it came out slightly better than expected, which doesn't say, oh, boom economy, but what it really says is you're not collapsing. Okay, it's at 50. It's literally at expansion. This was this is their services PMI, right? There's no consensus on that. I don't know, but it came out higher than the previous month. So their service manufacturing, okay, or their service economy, I like to say forward looking, service activity, still positive, right? Higher than the previous month. So they're both higher than the previous month. General PMI, this like combines the two, came in stronger. So the Chinese, right now, anyways, the economic activity for China is not pointing lower. It is not pointing to a massive collapse in China. Okay. And this is not a war against China. We're not talking about that. We're talking about literally the global liquidity here. Okay, if you own Bitcoin, you want China to be strong because they're going to buy more Bitcoin. They're not going to buy the Chinese yuan. They don't care. The Chinese citizens really probably hate their government. Chinese citizens can't, their savings rate is 50%. They do not trust investing in their own place, right? In their own city, in their own environment, in their own companies. They don't trust it. They don't trust the government. They don't have freedom like we do. So they're going to buy Bitcoin. No, I'm just kidding. You want the Chinese economy to recover though. All right. Now the EU, right? I was looking at EU inflation also, European inflation collapsing. This is good news. Rate cycle is turning here. Consensus was 4.5%, came in at 4.3. That's the year on year headline inflation. That includes oil prices. That's good. Core inflation, taking out oil prices, taking out energy, expected to come in at 4.8, came in at 4.5, beat expectations. Great. The month on month came in at 0.3. There was no consensus there, but lower than the previous month. So European inflation coming down. Plus, I still think the most bullish thing is for us that we've seen for the Fed in general. That remember, the biggest risk to the market is still inflation going higher. That has not been the case. Oil prices go up for a month and a half. Everybody gets scared. Oh, the seven. No, 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 because it's going to cut consumers. It's not inflationary. That is not inflationary alone, especially the way things are set up right now. Oil itself is not inflationary. Is it net inflationary? Yes, but it's not super inflationary the way people expect it. If it ticks up a little bit, it ticks up. But if you remove it, right, you remove oil, you remove gas and energy, what do you see? That, we're falling here. Look at this thing, looks like a rock. This thing is falling like a rock. Going back to 1990s, this is core inflation. It is falling. And the month on month, like I said, was at 1%, bro. You annualize that, you're at 2% inflation. You're at the Fed's target. I think the Fed gets to their target like this year. I think they get to their target this year in certain measurements, maybe not core PCE year over year, maybe not that one. Maybe it gets to two. I think we hit the twos though, for sure. I think this is all we have left to get to 2% inflation. 88.88%. No, I'm just kidding. Not 0.88%. That didn't make sense. That's really 0.8%. Really small amount. So once you get this shaved off, you're at 2.9. Investors are going to be so bullish. They're going to leverage in. Like, oh my God, inflation is coming down. The Fed's going to cut rates. We're in good shape here. They're going to get excited, right? That's what I think. As that core comes down. And the Fed remains high because the economy is stronger than they expected it to be. So that's why. So it's not a bad problem. The reason for the Fed to keep rates high is not necessarily a bad problem. For the economy, yes, unless you're a saver. If you're a saver, bro, you're literally earning interest. Well, you're better off investing than getting 5% a year. But if you're a company, you're gonna, and you have a lot of cash, you're gonna win. The winners are gonna win. The losers are going to lose more. That's what I say going forward. The winners are going to win more. The losers are going to lose even more. Don't be a loser. I thought we were going to bounce on Friday, but we gapped up, then dropped. Yeah, I mean, there was no big catalyst to really just bounce on Friday from Friday. There wasn't like a huge catalyst, but it's enough to get people bullish, right? We see the RSI is kind of trembling down here. It's like, oh, I don't want to go up. We're kind of stuck. That's okay. That's okay because that is the exhaustion. That is increased exhaustion here. Oh, the new glasses on TED. We'll get to that. So yeah, listen, the exhaustion continues. As long as this exhaustion continues, then one small catalyst. Look, when you're at the upside, when you're up here, when the market is moving higher, little good news doesn't make a big difference. But if it's bad news, it kind of makes things sensitive because people are overweight. The market is overweight, and it just takes one thing, market psychology, to unravel. But if you're on the downside, everybody's negative right now. Everything's negative. Oh, we're going into a deep recession. The bond market's going to blow up. Mortgages are going to collapse. No, they're not. Everybody's locked in long rates. Most people are not in short-term mortgages. The stock market can't sustain the rates. Well, guess what? Most equities are locked in long-term rates way long ago. The rates aren't even affected corporate profits at all. We're going to collapse. Unemployment goes down. Unemployment probably does go up, but you got fiscal policy coming in, right? Consumers are still spending to some degree. And hey, you're heading into an election cycle. The strongest Fed, you know who's stronger than the Fed? Joe Biden. He can do more than the Fed. He can sit there and do something stupid, which would reignite inflation. But if the consumer collapses, inflation collapses, and then boom, here comes a stimulus, right? So the worst thing is supply side inflation. That is the worst thing. You want to, that's a real risk there because it doesn't disappear from demand. Demand can fall and inflation goes higher. That's the worst case scenario if we see that. Um, Anyways, yeah, we're gonna bounce, bro. We're gonna bounce here. Look at the debt ceiling, not the debt ceiling, government shutdown averted. We already said that was trash. That was a stupid narrative. AUW strikes, we'll see how that goes forward. They're not huge yet, they're not massive, but if they continue, if they expand, it could cause, you never know, that could be a positive for the market too. You just don't know how it works out. Yields going higher is the issue. 10-year yields is really the big issue here. Um, I never heard this about China buying Bitcoin. Not China themselves. I mean, they will eventually, but I'm saying the Chinese citizens, right? They're going to buy Bitcoin. I mean, they have the second biggest mining rig in the world in China. So they, trust me, they're mining Bitcoin. They're mining crypto. Plus, you have tokenization of every central bank, right? China, Hong Kong, Japan. They're all making CBDCs right now. They're all creating central bank digital currencies. And the future of finance and banking in the world is literally they have their own blockchains. You guys just don't know this yet because you haven't done the research. It's not mainstream. They don't want it to go mainstream. But CBDCs are literally private blockchains. They're blockchains that are built on the damn central banks. So they build their own private blockchains and then they create a stable coin, but they cannot do anything about it because they can't connect to each other. It's like having T-Mobile and Verizon, but you can't connect because you don't have the same service. So they need something to interoperate. They need something to connect them. That something is CCIP, cross-chain interoperability, which allows them, it's like injecting a chain that connects two chains. Now you can transact with different other private chains, right? And other public chains. And that's why I'm so bullish on Chainlink, right? But either way, they're making that, they're doing this, and then they're gonna have access to Bitcoin through the chain. Like it's gonna be crazy. We'll see it. I think it's gonna blockchain and AI are gonna be the biggest market movers going forward, other than, well, actually there's a lot: electric vehicles, energy storage. We'll see how Tesla's doing with that. Anyways, does China do revisions on their economic report? Yeah, probably do. You really can't trust China, but so you really can't trust them. What they're doing right now is, maybe they're lying about their numbers, who knows? But we do have ambassadors over there checking the data. Who knows? We lie about our data. Either way, you're getting a rough estimate there. Um, I would say that watch the stock prices in China, because the stock prices are telling you what's actually happening. Stocks lead the economy, because if you're rich and you know you're lying about the data, you're not going to keep buying, you're going to sell. So watch the stock prices. The stock market really looks forward 12 to 18 months, because if you are a cheater or a liar, you're not gonna hurt yourself. You're gonna buy when you know something, and you're gonna sell when you know something's wrong before everybody else. That's why stock prices in general are a free market, because I mean, you can't really lie. The price tells you where things are going. Um, All right. So would you say thoughts on Meta with the new glasses, technicals? Meta, I mean, we'll see how earnings come out. The new glasses, Wall Street's going to be looking to see if those profits actually come out. What I would do here, and I kind of have this chart up here, is look at their, I'm trying to learn how to read this too. What the heck? Margin, gross margins. These are the gross margins. Wall Street is looking for, look at Meta's gross margins, how they've fallen since 2018. Um, Gross margins are how much profit that they're retaining after top line revenue. So they might bring in all this money, but how much did you spend to get that money? How much are you spending on new services? I think their margins start to go up. Meta's going to go to $1 trillion eventually. And so I think they're looking at gross margins. What do the glasses do for margins is the real question. I don't think it does anything immediately, but we'll find out on the earnings report, right? We'll find out during the earnings. It's all about earnings season right now. It's seasonality and earnings season. That's what it's all about. That's what's going to move this market, is stock earnings and stock earnings and yeah, pretty much earnings, because seasonality is done. On a technical basis, how does Meta look? Let's see. Look at Meta with the wedge. I mean, I know this is a lot of stuff. Let's get some of this off. Meta is still wedging. Meta is still wedging, man. It's wedging at 300. It looks good. All you got to do is say, hey, whenever, and mark my words, when you see the cues start to bounce out of this trend, right? They broke the trend and then sold off. If the Qs open up strong this week and hold, Meta's going higher. Meta's going to go higher because the NASDAQ, the overall market, leads individual stocks most of the time, not always. Have you noticed that when you log into Facebook now, it pushes you straight to the video section? I don't log into Facebook actually, so I don't know. Not the news feed. And there's going to be a lot of crazy political stuff now because they're trying to ban people. There's going to be a lot of political spend into social media, as always, head into an election. So yeah, keep track of what you're seeing because it's going to be crazy, man. Especially with AI, they're going to try to ban certain content. Don't say this, you can't say that on the platform. It's going to get wild. Who knows? It's going to get wild though because that's how you win an election now. Is you got to get more reach, and that's on social media. All right, what else do we got here? Looking at the prices here, I'm gonna just go over some stuff. Let's see, Tesla. I'm gonna go over Tesla as always. I'm actually looking to get some Tesla here. They have earnings on the 17th, 18th. Okay, earnings are on the 18th, so that's second half of pretty much the first middle of the month. Pretty much the middle of the month. You got a neutral doji star here. I don't know what it's called, but I know what it means. What it means is if you break up, you're going higher. If you break down, you're going to probably retest the lows. And that depends on the market. The market is running things right now. The overall S&P 500 is running things. So on the, Tesla is trending though. It's above the VWAP from the lows. It's above the 200 moving average. It's starting to move up on the daily. And this is your level, right? What is this? 247? I want to see it hold 250 after looking at this doji. This kind of could be a new support. Tesla does a lot of crazy stuff, but 250 above, if it can hold 250 and you really see a nice setup on the intraday, maybe it's a pattern, maybe it's a wedge, maybe it's a reverse head and shoulders, maybe it's a cup and handle, maybe it's a falling flag pattern above VWAP, whatever it is, above 250, Tesla's probably gonna have a nice push back to the 260. And it gets there quick when it runs, right? Now, is it going to stay up there forever? Maybe not. Maybe it's a quick trade. Maybe you hold it, but it could always come back down also because we're going to get deliveries also on Monday. Deliveries, that number, this is why it's wedging here because deliveries, it's anticipating worse than expected deliveries, which is good. I like that it's anticipating that. If it's true, it's nothing. It means nothing. It priced it in. If it's false, price goes higher. Oh, better than expected, right? If it comes in worse than expected, well, that's not going to be good. So yeah, low expectations and then high performance for Tesla. What else we got? Nothing. And then looking for, Chainlink, looks like it's at the top of the trend. Ethereum also trying to break out. Like Ethereum is breaking out actually in this small little pattern here. There's a ETF. There's some rumors that there's going to be an Ethereum ETF. You can't trust anything right now. Rumor this, rumor that, still moves price. But at the end of the day, that would be weird. They have a Ethereum ETF before the Bitcoin ETF. I know people say that. Could you talk more about what you think would happen with the dollar on Friday's news? So Friday's news. So Friday is going to be. Friday we have, let's take a look at what we have on Friday, coming up Friday. Pretty sure it's the employment report. Are you talking about last Friday or this Friday coming up? Pretty sure you're talking about why did my chat disappear? Oh, there it is. This Friday. Okay, would happen. Okay, so this Friday coming up. Yeah, there we go. So Friday we have coming up this next Friday, we have the employment report. Oh dang, this is the whole month. Cool. Well, let's just go through it either way, Monday through Friday. Monday, ISM PMI. Watch for new orders. Where's the new orders at? Here it is, new orders. I want to see those new orders tick up. That just means the economic activity is picking up faster than anticipated. This always leads the risk asset cycle. because it means the economy is back, right? Even though you hear the opposite, it's up in some areas, down in others. Construction spending, I want to see all this data. We'll probably report on it. Fed speak, jolts. This is going to be huge. Job openings, if they're going to keep falling. Job openings keep falling, then yields should ease off, the dollar should ease off. If for some reason job openings tick up, the dollar could move higher, yields could move higher. Yields lead the dollar right now. Why? Because the higher the yield, the more valuable it is to hold dollars. ISM services, we'll see. Services are probably going to be flat. We're talking about job support, non-farm payrolls. It's expected to come in lower than the previous month, 158. So this one's been revised so many times, it's hard to trust. It really is hard to trust. So non-farm payrolls, I don't know. I got to think about this one, but I would say you can't trust it. I say they go lower. They're definitely not going to tick up. There's no way, especially with the UAW strikes and the a lot of the, I think payrolls go lower. And if they go lower, yields should ease because it means less spending, less jobs, less spending, closer to recession, buy bonds, right? They should ease, dollar eases. Unemployment rate ticks up, the dollar eases, definitely eases if unemployment goes up because it signals recession. And some people would say the dollar would tick up, and it's possible. But right now, the dollar's, it's not like unemployment is spiking. That would be risk off. It's not. It's going to go into yields. I'm sorry, it's going to go into bonds. If if the economy falls off a cliff, capital goes into bonds first because you're going to get a free interest rate. You're going to get a free payment from the government. That's why people buy bonds, unless inflation's up. Average hourly earnings year over year. Yeah, this is wage inflation. This one's going to be very important for the Fed. Coming out 4.3%, probably stays flat. If it hasn't been moving lately. If it stays where it's at, I think nothing happens. If it moves up, this could cause yields to climb and the dollar to climb. If it moves down, typically the dollar moves lower, yields move lower. The yields and the dollar are moving together. They did separate for a while for very specific reasons. Why did they separate? They separated. I don't remember. I remember we reported on it. They separated for a while and then they came back together. I think it was the reverse repo facility was was doing something. I don't know. I don't remember. So yeah, those are the big major things there for the Fed. I'm sorry, for the dollar, right? Unemployment goes up, dollar goes lower. Because that means easing. That means quantitative. We're closer to quantitative easing, which is debasement of currency, which is devaluing the dollar. Dollar goes lower. Non-farm payrolls go lower. Dollar goes lower because less spending, weaker economy, same drift. It always leads to weaker economy or stronger than expected economy. And then average hourly earnings. These are inflationary. If these go up, it means more inflation. That also is going to move rates up. That's going to move the dollar up. So yeah, those are probably the most important factors there. Hopefully that covers everything. Does that make sense? Um, what would ease the dollar? Oh yeah, I just went over that. So dollar going down. Yeah, you could record. I mean, you can go back. But basically answer your question. What would ease the dollar there? Anything specific that you're confused about? ISM is going to be important though. Economic growth picking up. Everybody thinks we're headed into recession. I happen to think it's not the case yet because people will keep spending into the holiday season. If we get recession, are closer to recession, like really close, I think it's going to be in January, February when people give up on spending. When they're like, "All right, my debt's too high. I need to stay inside. There's no parties anymore. It's January. I need to go to the gym. I need to be more disciplined. The party's over." And they slow down, the credit card debt's up, maybe the defaults start to rise a little bit. I think it's going to be January, February, and and then the response is, well, does the White House come in and start saying we're going to cut taxes? That'd be amazing. They start cutting taxes, the market's going to rip, or start talking about cutting taxes. That's why I am staying bullish because when it comes to politics, when it comes to the politicians, the best way to get elected is to somehow make the economy go higher. So they're going to talk it up, right? And the market's going to price it in and go higher until it actually happens, then the market sells off. It's a forward-looking mechanism. So that's what I got for you guys. Yeah, thanks a lot. That's why I'm doing it on YouTube too. So you can always go back and take a look at it. Um, anyways, I would say for me, the thing I'm most excited about, I don't know what you guys are most excited about. Very excited, like Chainlink. I'm gonna say it. Chainlinks, if what we're seeing is true, this thing is gonna lead the altcoin. I'm not gonna compare it to Bitcoin or Ethereum, right? That's just disrespectful right now. I'm not gonna do that. But this thing is gonna outrun all these damn coins. Look at this consolidation. This thing is going to smash. We take off the fib retracement from the highs. Let's not even do the highs. Let's just do from the current where it's been getting corrected at. I think Chainlink is going to run into January. If we get this Santa Claus rally, altcoins are going to move also. Bitcoin's going to move also. Okay. It's not going to stay stagnant, especially if rates come off. I think we head to $12 pretty quickly, and possibly we run to like 16, 17 for Chainlink. Right. And it could go all the way to 20. I mean, it is altcoin. But it's not like an altcoin meme coin. It is literally, just call it World Economic Forum coin. Oh shoot, my bad, bro. Oh my gosh, what a see. That's why here. Let me hit it for you guys. Hold on. Here, I got you. Turn this off.
Stupid. Stupid.
There we go. My bad. All right, so turn that comment off. Yeah, my bad. I didn't even show you guys. Anyways, big consolidation, blah, blah, blah. Looking at the fib retracement, I think we head 12 pretty quickly, and then maybe up to 16. Like I said, 16, being a little more conservative. If it's really, really good, I think we run to 20 right before January or going into January. That's a very big possibility. Then you retrace, it could come all the way back to $10. You could always come back to 10, but I'm very excited about it because that's the best fundamentals of all the coins. It's not XRP. XRP is a ledger that other central banks have to use. They don't want to use a ledger. They want their own blockchain, right? They have to use that ledger. No, they don't want to do that. They're going to use their own private blockchains, and they're not going to trust DeFi, but they want to plug into DeFi. And they're going to have to use the Chainlink network. Swift's already using it, quadrillions of dollars of, and think of it like Visa. You know how you swipe your card and Visa takes a percentage of your payment? Well, that's what CCIP does. It takes a percentage. The revenue comes from the transaction. So if it takes a small percentage of a quadrillion dollars of transactions, well, shit, that's a lot of money for a small coin. Excuse my language for you guys that have virgin ears. My bad. KRE collapsing, right? See if the Fed pumps in that. Yeah, that's what, and then also Tesla. I'm obviously, excited about Tesla. We'll see those deliveries come out. Could still have some bad room because the margins are still very low. The market can do two things about Tesla. Either say, damn it, your margins are still haven't bottomed, we're going to crush you, or say, well, this is the bottom of margins, and then bid up to that conference call is going to be important because they're going to signal we're increasing production again. We're heading to the fourth quarter. Most people, how many people are going to buy a Tesla into the fourth quarter, right? A lot, right? As a present, especially with the prices dropping, the Model S at 100K now at 79,000 with all those government rebates going into 2024. So like I'm looking at Tesla, Chainlink. Obviously, those are my two most interesting, Ethereum, Bitcoin, nothing really. It's all about ETFs for that. Anyways, that's all I have for you guys. Sunday. Make sure you guys pray today. Thank God for what you have and for what you've been given and that you have breath. Wait, what? Do you think I can make a living trading a few stocks a day? No. No, it'd be very difficult making a living trading a few stocks a day, I think. It'd be very difficult, Mikey. I'm just going to tell you the truth. Listen, 90% of traders, 90 to 95% cannot do it consistently. They can't do it consistently. I'm not even a consistently profitable trader. I was at one point, but I switched it up. I didn't go all into it for personal reasons, but I do swing trade and, trading a few stocks a day. No, I don't think so. You got to be you. But what I'll say this, you can do it, but it's going to take years for you to get good. I'm just going to tell you the truth straight up. I'm not going to sit here and say, oh yeah, you could do it. Like, bro, you're going to get torn up. You got to have a lot of practice. You got to have a lot of experimentation, see what works with you best. Maybe you could be a swing trader, make it on the side. What I would say is this. Why? Because it's hard, it's difficult. I mean, I have some stuff on my website that goes through trading. Read it, read through all that. That is like a fifth of the information that you really need. Read through all the trading stuff I have. If that's too much for you, you're not going to make it. It's hard to be a good you could trade and be profitable, like, meme stocks, and just buy it goes up. If you don't know why you're making money, you're screwed. You're going to lose big one day and lose everything. You have to know why you're making money, how you're making money, where your edge is when the market changes. Is your edge still there? Did it disappear? Do you understand technicals? Do you know what the macro is important? Do you understand market psychology? Not just it goes up, it goes down. Like, there's so many factors to it. Do you have the time? Can you invest in yourself? I'm not saying you can't do it. I'm going to tell you it's hard. It's going to be very hard. Investing is easy. Everybody can invest if you buy the right stuff. Obviously, if you go buy, some crap coin or some stupid company, you might, be in trouble. But definitely everybody can invest. Trading is hard. Anyways, like I said, we'll be on tomorrow. I'll have a new guest tomorrow. Entrepreneur, built a couple businesses, and we're going to talk about we'll talk about the market. We'll also go off on entrepreneurship so you guys can get another flavor of somebody else, and also kind of the stories that are going on that are a little off topic for in our society. So we'll talk a little bit about that, how to be successful, and that'll be tomorrow morning. I think 12:30 p.m. Eastern time, which is 9:30 my time. We should be running that show. Again, thank you guys for showing up. I appreciate you guys. Hopefully I gave you some good content. Don't forget to like, subscribe, hit the button, hit the like button. I'm still trying to get to 1,000 subscribers. If you guys could help me out there on YouTube, hit the likes. And other than that, you guys stay blessed. As always, stay blessed. Get your prayer in, get your exercise, hit the sauna, go for a walk, stay positive, right? Stay positive. Well, I don't want to say stay positive, stay learning. Sometimes you got to be negative, but only to reevaluate why, right? You can't always be positive. If something's bad, right? You can't change how you feel, but change your mindset around it. Understand what is negative, understand what is bad, and change your mindset to say, okay, this is why. Don't ignore it. This is why this is not working. This is why I need to change this. And then you'll feel better about it. So accept the negative, and then alter your mindset. Understand the mistakes you're making. Understand those mistakes, come up with a game plan, and execute. Aim high, focus on the day, focus on the night, get a good sleep. That always helps the most. Anyways, catch you guys later. Stay blessed. Peace out. Slimesy, I see you.